Hi, I'm Jim O'Shaughnessy, and welcome to Infinite Loops. Sometimes we get caught up in what feel like infinite loops when trying to figure things out. Markets go up and down, research is presented and then refuted, and we find ourselves right back where we started. The goal of this podcast is to learn how we can reset our thinking on issues that hopefully leaves us with a better understanding as to why we think the way we think and how we might be able to change that to avoid going in infinite loops of thought. We hope to offer our listeners a fresh perspective on a variety of issues and look at them through a multifaceted lens, including history, philosophy, art, science, linguistics, and yes, also through quantitative analysis. And through these discussions, help you not only become a better investor, but also become a more nuanced thinker. With each episode, we hope to bring you along with us as we learn together. Thanks for joining us. Now please enjoy this episode of Infinite Loops.
Jim O'Shaughnessy is Chairman and Co-Chief Investment Officer of O'Shaughnessy Asset Management, where Jamie Catherwood is an associate. All opinions expressed by Jim, Jamie, and podcast guests are solely their own opinions and do not reflect the opinions of O'Shaughnessy Asset Management. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of O'Shaughnessy Asset Management may maintain positions in the securities discussed in this podcast.
Well, hello everyone. It's Jim O'Shaughnessy with my colleague Jamie Catherwood for another episode of Infinite Loops. Today, I have a very interesting guest who I first met at a soiree that Patrick, my son, and Brent Beshore put on, where I wish you could see Dan Rasmussen, who is the founder and CIO of Verdad Advisors. Now, Dan, I got to say, you are the Manchurian candidate. And the reason I say that is because you are so pleasant looking and you're a good looking guy. You kind of just look like you fit in. You could probably walk into any club in Manhattan and they'd say, right this way, sir. And yet, what I love about you and what I want to talk about today is, I was making some notes for this, and right in my mind pops the Dr. Dre song with the Eminem lyrics that me and Dre stood in front of the burned down house. There we were with matches and a full can of gasoline, and still no one found out.
It's the first time, for the record, I've ever been compared to Dr. Dre, so this will be a one to write home about.
So what I love about it, though, is you are kind of a classic debunker. And I love that because what you debunk, we have a lot of things in common, and we're going to talk about them. But one of the things that is great is, do you have to have security when you're going to a VC conference or
I did a conference, a big endowment conference in Toronto. And that was actually my opening line, was that I said, well, you guys, thanks for paying for my flight up here and my hotel, and also for the bodyguards that you're going to have to escort me after. And then I just spent half an hour. I actually started with, just to be really obnoxious, I did a survey and we said, what are your expected returns expectations for private equity? And it was a room of endowment professionals. So I think the majority said, 4% a year outperformance of public equity. And then I said, what do you think the average credit rating on your private equity companies is? And I think, again, the majority of some said investment grade. And then I just went through and said, well, here are the last 10 years, which were below 4, and the actual credit rating is triple C or single B for 90% of it. So you guys are way off on returns and way off on risk. And probably your job is risk versus return. So you might have an issue. And gee, I thought I was going to be heckled or thrown eggs, but I managed to get out of there alive.
Yeah, that's really cool. And like me, I bet your motto is nullius in verba, right?
You're going to have to do the translation for me, Jim, because it's been some years since my Latin.
Take no man's word for it.
It is
the motto of the British Royal Science Society that Isaac Newton founded.
I love that. I take one thing on faith, and that's the resurrection of our Lord, and everything else, I'd like to see the evidence, please.
There you go. Okay, well, let's jump in. I'd like to start with your newest piece of work, which I found fascinating, about emerging markets and crisis. I'm going to let you go, but emerging markets have always kind of been a challenge, right? Especially for quants, because the data is iffy. There's a lot of problems. But If you would you walk us through the thesis and then some of the information you have supporting it?
Yeah, sure. It's so interesting. I mean, I think there are these sort of investment fads that everybody sort of believes for a period of time. I mean, I think the one of the 2010s is private equity is the best thing since sliced bread. But before private equity was the best thing since sliced bread, emerging markets were the best thing since sliced bread. And you had this amazing World Bank report, I think in 93 or 94, saying the Soviet Union has fallen and we're going to see this massive economic resurgence across all of these emerging markets. And you should put your money there, go invest. And the returns since then have just been disastrous, despite everybody from the World Bank to some quant funds saying, EM is cheap, it's the best thing. And I think my sort of question was, well, why? What happened, right? Like, why didn't emerging market stocks work? I mean, it seems like they're illiquid, they're obscure, that should be helpful. Certainly at some point, they've got to be cheap, and that should be helpful. So where's the problem, and why? Sort of the biggest sort of headline error, right, was Harvard management, who, if you rewind back to 2007, it wasn't the Yale model, it was the endowment model, right? Because Harvard was crushing it. And they had a totally different approach, that they were doing all in-house management and whatever. And they hired Mohamed El-Erian, who's the World Bank guy that wrote that report in 94. And he said, well, gee, emerging markets, not only are emerging markets, it's a great thing to invest in, it helps close the gap between rich countries and poor countries. And so it's good for the world. But look at the returns from 2001 to 2007. They've been so good. Harvard needs to really amp up its bet in emerging markets. And what's related to emerging markets is commodities. I think Harvard put 20% of its endowment in emerging markets and commodities in 2007, sort of on Arian's guidance. And he published a big book that year about a global convergence between poor countries and rich countries. And then you don't hear about the Harvard model anymore for sort of a reason, right? And they've finally finished undoing all of those things. It took 10 years because it was so illiquid. And now actually probably it's a relatively decent time to be owning commodities in emerging markets. So there's sort of an irony. Like by the time you got out of it, there's actually some interest. So I started looking into it, right? And I think my first question was to look at crises in emerging markets. And I've gotten really interested in crises. And one of the reasons I like crises is because when you're in one, right? I mean, I think the challenge of, say, if you're analyzing bubbles, well, whose definition of a bubble? Are we in a bubble now? Are we in a bubble before? Are we in a bubble in 98, right? You never really know if you're in a bubble or not, but you absolutely know if you're in a crisis. It's just so clear. So as a quant, it appeals to me because nobody's really going to argue with my definition of a crisis, right? They're not going to say, oh, no. Argentina wasn't in a crisis then. Yeah, the equity market was down 55%, but it was fine. The market was fairly valued, right? Like, you get it. We're in a crisis. And so it provides sort of this unique, I think, time for quants to say, hey, if there was a time when we know something special is going on in the markets, or it's sort of a unique economic environment that we all agree is unique, we all know we're in a crisis. So I got started studying those in the US. And then I said, well, the natural next place to study them is in emerging markets, right? Which have been so crisis prone. And I think maybe 3 or 4x as many crises as developed markets. Seems a constant series. And there's a mix of, like, first of all, whenever there's a global economic crisis, there's an emerging market crisis on steroids. I mean, everybody just flees to safety. No one wants to be in there. And you sort of think of the logic of that. I mean, maybe you're not as sophisticated as Harvard, but you've decided to, like, you've got a 90% US portfolio, but you bought that Indian bank that your friend recommended. Well, when the market's down 30%, what's the first thing you liquidate? That stupid Indian bank. Why do I own that? I don't know anything about India. Maybe the government's going to steal it. It's probably down 50% for a reason. Let's sell it. So you see this very exaggerated. And then, like Turkey today, right? Like, you see the idiosyncratic crises, right? Where the government makes some terrible policy decision, or they're exposed to some industry, and the country just sort of goes through this collapse. And those I sort of call the idiosyncratic crises and the global crisis, but I segmented them out because I think they have different drivers. Like, Turkey's selling off not because there's a liquidity flight from emerging market, but literally the prime minister of Turkey did something really dumb. So if you segment those out and you define a crisis, how do you define a crisis? I just define a crisis as a 50% drop in the equity market. And I got that from this Yale professor, William Getzman, who's sort of a professor, an expert on bubbles and on what he calls negative bubbles. Really a fascinating guy. And he says 50%, I think he looked back to like 1600. And said 50% is his definition of a negative bubble. And a negative bubble and a crisis are sort of similar, or at least as an investor, you're looking for crises that are negative bubbles. So there's too much fear, too much panic. So I used that definition, the negative 50% decline, and then started to look at what comes next. And broadly, what I found is that if you were to buy emerging market equities only during global crises when emerging markets were in a negative bubble, so you just said, okay, the S&P 500 is down 20. I'm going to buy every EM country index that's down 50% or more and hold for 2 years and then sell out and go back to cash, you'd have dramatically outperformed buying and holding emerging markets. And then I think the next part is if you look at those idiosyncratic crises, actually buying the country equity was not a good risk return because oftentimes, like in Turkey, yeah, go buy Turkish equities right now. Great idea. Let's see what happens next. What does the prime minister do next? He's just sacked the central bank. What's he going to do next? And you see that play out in a lot of these markets where the equity market never recovers. But what's interesting is that the dollar denominated government debt actually does pay off relatively reliably. So we developed this simple rule: in global crises, buy EM equities, and in idiosyncratic crises, buy the debt, but don't buy the equities. And that pairing, I think, worked really well. So that was sort of the outline of the paper, was just saying, hey, buy and hold an emerging market has been a disaster. In part, it's been a disaster because of these constant crises and liquidity flight. And we can talk more about liquidity and the role that plays in emerging markets, because it's really interesting. So if you just segmented out and only bought emerging markets during these crisis opportunities, were thoughtful about whether to do the equity or the debt, you just did so much better than sort of listening to all the experts who were telling you to. You could almost think of EM as sort of the original ESG, right? Before ESG was buying green energy stuff, it was helping out third world countries. And so emerging markets had this big overlap with ESG, which also was part of the big story. So I'll pause there, but that's sort of where we got to with the research.
So we think in a similar fashion. When we published the generational buying opportunity in March of 2009, it wasn't because I had any great insight. It was because we looked at the data. And I said, okay, so these 10 years ending February 2009 are the second worst 10-year real rate of return for US markets back to 1870. Let's look at what happened in the other 49. And so obviously, after 3 years, the other 49 showed incredibly positive results. And then coupled with that was also the fact that the long bond had outperformed the equity market over the previous 30, 20, 15, 10, 5-year period. And the last time that happened was in 1944, I think. I haven't reread it recently. So I love the counterintuitive aspect of this. And I agree about emerging markets, the buy and hold there, I would not advocate. So I really do like this theory a lot. I also remember, though, when I was younger and diving into this stuff, I subscribed to the Journal of Portfolio Management and all the geeky stuff. That's when you had to actually get the thing in the mail. And I was thinking, as I was looking at the notes I was writing up, there was a series of articles, I can't remember who wrote them, but they were looking at international markets. And I think the piece was actually in 1981, so I would have been 21. The author took apart international markets first by value, so PE, price to book, et cetera. And then he had a follow-on, I think in 1980, whatever, 89 maybe, where he took them apart by dividend yield. And his strategy was buy the 5 countries from the MSCI International Index that have the lowest valuations or the highest dividend yield. The challenge was it didn't go on to work. So how do you account for that within the confines of what I find a very intuitively seductive strategy?
Yeah, Jim, I think it's something that as a value manager over the past few years is something that I've wrestled with a lot. Why does sometimes cheapness not work? How can you have been a value investor through 2018, 19, and 20 and not have asked that question? So maybe that's in the ether, right? It's like clearly value doesn't work sometimes. And like I was talking to some really smart investor the other day, and he said, well, we came to this realization as a firm, they're a fundamental manager. We came to a realization, you shouldn't just buy stocks just because they're cheap. That's not enough of a reason. And I thought to myself, oh, shoot, right? Like, what have I done with my career? What an idiot I am. But by golly, that's been the right answer for 2018, 19, and 20, so whatever. But I think I look back and say emerging markets are sort of one case study for that, or a sort of broader area where they had to be really cheap for it to work. And so I think what I sort of said is if you think maybe cheapness doesn't work if it's sort of marginal, well, maybe it should work more at the extremes, right? Maybe if things are really cheap. And actually, if you ran our crisis analysis piece and instead of a 50% drawdown in the market, you started tilting it back. What if the market's down 20% or 30%? Actually, the alpha just comes way, way down. So there's something about extremes, I think, that matter in markets, and I think matter in quant. There's another study I saw a few years back that said that returns are 8 times as predictable in crises as they are in non-crises. And I think there's some truth to that. I think about when should value work? Well, it should work at the extremes because that's when the behavioral bias is clear. That's when the liquidity is real. I'm actually maybe drawn to some of these liquidity-driven arguments or behavioral arguments. If you're thinking about something cheap, you want it to be cheap and to be reading newspaper headlines about why it's terrible. You don't want it to be cheap and no one's talking about it, the real extreme stuff is what I'm really quite interested in. Because if you look at sort of this last decade, which has been quite terrible for value, when has value worked? Well, it actually really worked a few years over the last few years. Worked really well in 2016. It worked really well from March 2020 on. And so what were the difference between those periods and the periods when it didn't work? And one of the reasons is we were coming out of economic crises, right? There was a sort of quasi-recession in 2015. There was an obvious one in Q1 of 2020. And you see this consistent pattern, right? Where during these crises, and actually the factors from Scratch paper, which you guys put out, which I have made as signed reading to my interns because it's so darn good. But if you think about that framework from the crisis perspective, the growth stocks do better coming into the crisis. They really do. You paid a higher multiple, and by March of 2020, you were happy that you'd pay that higher multiple for Amazon. It actually did better. And that actually really mattered in that early stage of the crisis to own a better company with better margins and whatever. You were actually doing better. So paying higher prices was sort of fine coming into that. But then you had this weird reversal where by March of 2020, you were sort of thinking, well, wait a second, I got the benefit of owning an acyclical sort of secular growth story. And everything that's cyclical was cheap before because people didn't want to own anything cyclical. And then the cycle hit and their revenues are down 20% this quarter and their profit is down 60%. And then you say, well, let's fast forward a year. And that's sort of the factors from Scratch. You move forward from time, rerun your model. What's my growth expectation now? And therefore, what's going to happen to my multiple in the future? And you come to this conclusion, you say, oh my gosh, actually, value stocks are probably going to grow faster than growth stocks. And they trade at a bigger spread valuation-wise than they did pre-crisis. So you're buying them even cheaper, even though their expectations are much better. And you're probably expecting significant multiple expansion in a year from now once people recognize that. And I think that those sort of dynamics sort of play out in these crises. And they play out in emerging markets as well. Those are sort of the ultimate cyclical markets because they're so commodity exposed.
So mechanically, how do you go in and buy? Do you buy in the market or do you buy ADR? Or you said debt, so you can't be doing ADRs, I don't think. What is your process?
We're still working on it. This was more of a thought piece than something we implement today. It's something we would like to implement in the future. We just missed one of the great buying opportunities in emerging market value, so we'll wait for the next one. But I think the idea is basically what you want to do. You can do it two ways, right? You can buy the country level indices essentially, right? And just sort by which country got hit the worst and buy the country level indices. That's a fine approach. And we tested it that way. And the results of doing it that way and the other way I'm going to describe are equivalent. The other way to do it is to do a simple factor model, right? And within the liquid emerging market stocks, which there's a lot of illiquid stuff, but within the liquid stock, just do a classic, if I'm a French value sort by price to book or sort by price to book and profitability and buy the top ranked things. And that works really well too. So, and the results are virtually identical because you're ending up with the same stocks. You're going to end up weighted in those countries anyway. But those are the two ways to do it. And then with debt, you want to buy sort of the USD or euro denominated, the foreign currency debt, not the local currency debt of the government. Although I think there's some interesting potential for the sort of quasi-governmental, infrastructure debt or other things like that. I've talked to some people since the report came out that suggests that there's an interesting opportunity across the credit markets in those countries during those periods. So that's something we're looking into as well. So I'd say this was sort of our high-level theory, point to the opportunity, and then now we're sort of digging in at the underlying name by name implementation questions.
So you mentioned before we started recording that, and I was teasing you about needing security. Are you finding that institutional or endowment type investors are open to this kind of thing, or is the narrative just too difficult for them to overcome? I mean, one of the things that we found is the career risk part is much more intense than a lot of people think, both for the manager and for the person giving that manager money, right? So it's a double whammy. Do you think that the efficacy of the theoretical approach that which is great, by the way, and I urge everyone to read it in full. It's like 80 plus pages. I read most of it, but how many pages is it?
Something like that.
Yeah. So it's really well done. What's your reaction that you're getting from traditional endowment investors, traditional institutional investors?
Yeah, it's quite interesting, actually. I mean, I think that if you think about quant equity or sort of what works in quant equity, right? I mean, you kind of have to go into illiquid corners of the market to make it work really well, right? At least its best returns are in micro and small cap. There's still good returns in the rest of the market cap spectrum, but the biggest hit of it is in micro and small. The cost of that is illiquidity, capacity constraints, and volatility. And I actually find that's a tougher pill for a lot of institutions to swallow because they say, oh, well, eventually we'd like to size up to 200 million. Can you do that? And you're like, not in microcap. How about 25? That would be big. And so it's just not enough to move the needle, right? The alpha opportunity there for a lot of the big institutions isn't enough to move the needle. So they're sort of interested in it as a smaller allocation, if so. But I think a lot of the institutions, they want to deploy larger amounts. They want to find strategies they can really scale into. And I think at least the portions of quant equity we focus on, which are sort of microcap, deep value, international, that sort of stuff, it's a bit harder. It's actually better for retail and family offices who have a smaller amount of money makes a bigger difference too. But I think that the crisis stuff actually is quite more interesting to institutions, in part because it's quite scalable, or at least more scalable. Because when liquidity flight, when people are panicking, you can dump a lot of money into these crises before you start to move markets because there's just so much selling. And then I think the second thing is that if you think about all the institutions have really moved to this endowment model where they have big private equity and venture allocations. And one of the really obvious big things you see in the data is that the capital calls of private equity and venture capital, especially private equity, are really cyclical. So when valuations are high, they call more capital. When valuations are low, they call less capital. And this isn't like a conspiracy theory that the private equity people are total idiots and don't get how markets work. They get it. They know that the opportunities are better when things are cheap and not as good when things are expensive. But there are two other dynamics going, which are that private equity, you have to have a company to buy and you have to have debt to buy it. And so if you have some really great family business you've owned for 100 years and you've decided that this is the year to sell it, and then the market crashes, you think, probably we should wait a year. I don't want to sell my family business this year, right, when the prices are so low. So the sales volume dries up, no one's selling. And then the next thing is the debt market's closed. So all the banks and the lenders say, heavens no, we're not giving you more money to go out and buy business. Do you know how uncertain the market is right now? Like, we don't even know if we're going to collect our interest on the existing companies you guys own. Like, holy smokes, absolutely not. So private equity is just dead in the water. There's nothing they can do. And then all their deal guys, they're redeploying the portfolio companies anyway because shit's hitting the fan and they don't know if they're going to meet interest payments. So you have this big problem actually for a lot of the institutions where their capital flows are super pro-cyclical. I think that this crisis strategy, or the idea of maybe you should put some money in public markets during times of equity market dislocation from your private portfolio, because you're not going to be deploying any work on your money in your privates anyway. And by the time the market recovers, that's when private equity is going to be calling capital again anyway. So you'll be getting money back from your publics and you can go deploy it in privates again. And I think that's actually really resonated with a lot of people, which has been nice. And I think the other dimension of it is that there's a certain type of investor that when the markets go down panics. And then there's another type of investors that says, okay, find me the craziest, most aggressive thing I can possibly do to take advantage of the chaos. And I think that I like to be that guy. Like, when the markets are absolutely panicking and you want to go long, call me and we'll find a way to deploy some capital. I like that because I think it's much more likely to work than a lot of other alpha strategies.
What do you think of private equity during all this, like the last year with COVID? Because I remember during like March, April, Minsky moment was like the hot buzzword because people were saying that this is going to be the Minsky moment for private equity, where all these companies that they had levered up with debt are going to come crashing down, and that's going to hurt private equity. But it seems like there haven't been any kind of high profile issues so far. So do you have any, I'm sure you have thoughts on this. I don't know why I'm asking if you have thoughts.
No, there are a few things that are going on, and expand the discussion of private equity to private credit too, right? Which is now all of these firms have their own private credit arm and they're lending to each other's deals and blah, 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 right? So there's a few sort of interesting dynamics associated with that. One is you did see a lot of those private credit firms are publicly traded as BDCs and those sort of things. So you can actually get some insight into what's going on. They had a massive drawdown in March. So they were down, the BDCs were down 40, 50%. So people were treating those BDCs as triple C credit, which is what they are. And so that was sort of an interesting moment. But what happened, right, is that everything snapped back so fast. And actually, private credit has this sort of extend and pretend ability. With, they're creatures of the private equity firms. They don't want to mark to market. They don't want to admit a bankruptcy. They don't want to call a covenant violation. They just do an amendment and they keep rolling over. And so what sort of was interesting about what happened this year, right, is you saw that private credit play out in a really interesting way, right? All the private equity deals that were financed by private credit, they were fine, right? The private credit guys say, hey, whatever, take a quarter, don't send us interest, let's talk again next quarter, right? And so that system worked really well to sort of extend and pretend. Just, we'll give you a little bit more debt, a little worse terms, and we'll deal with it later. And that was fine for both parties. And I think the other dynamic, which I'd probably underappreciated, which is quite interesting, is the extent to which private equity over the past few years is really tech private equity. I think it might be upwards of 50% of the deals are software related. I mean, it's a big macro bet on behalf of these shops. If they're looking at industrials, they'd rather look for an industrial vertical software company than buy an actual industrial manufacturing plant. And I think that also played out to their benefit in 2020. So I think that what's ended up happening is that private equity, and this was my thesis originally, was that private equity between, call it 2006 and really post-crisis, private equity made a switch from being levered small cap value, which again, I think is a great strategy, to being levered small cap growth, which I think is a terrible strategy. And so my thesis around private equity is you probably don't want to put 40% of your endowment into levered small cap growth. Like if you've ever looked at a long-term back test of small cap growth, it looks bad. And if you add leverage to that, especially leverage that is at like CCC bankruptcy level, like there are two things that don't get compensated, right? Bankruptcy risk and overvaluation risk. So why take both in one illiquid package? And yet, growth was what worked last decade. So they didn't get punished. In fact, they got rewarded for doing that. And so I think what's going to happen, and the key acid test, right, is what happens next. And you started to see cracks, right? Greensill was one of the first big private credit lenders to go KO, and it had all the hallmarks. It was illiquid. You didn't actually know what the loans were. They were marked in strange ways, marketed to different people. I mean, it was just like you play that out. And yeah, that was trade finance. It wasn't private equity debt financing. And it's a little bit like saying just because LTCM blew up that all hedge funds are bad. And I don't want to be that guy, right? Obviously, Greensill is unique. Don't you kind of look at that and say there, but by the grace of God, go 15 other private credit firms? And so I think that it's a little bit of a scary ecosystem, but the tech exposure and the ability of private credit to extend and pretend has largely gotten them through this crisis, at least.
So that leads me into the other aspect of your work that I actually love, because that's the Molotov cocktail throwing part of it. And I mean that with the greatest respect, which is kind of this idea of the persistence of bad models, which you have a paper on, and which I find very interesting. John Merriweather, who you just brought up in long-term capital management, absolutely blew it up. I knew those guys and was saying, leverage guys, illiquid, not a good combination. But then he went on and raised another fund. And then you have things like, as you note in your paper, the two guys, Fama and French, who came up with the capital asset pricing model, after decades come out and say, whoopsie, it doesn't work, guys. And then you've got Markowitz, who is the founder of the Efficient Market line. But does he invest his money that way? No, he does a naive distribution heuristic where he does a third, a third, and a third. And when asked why he did that, he cites he didn't want to have regret. I mean, have you ever really kind of taken a 30,000 foot look and just, is there some kind of pattern that involves human behavior, that involves the halo effect, that involves theory taking precedence over actuality, like capital asset pricing model, all of this stuff, interesting theoretical framework, doesn't work. And, I've always cited as one of the primary differences between practitioners and academics, right? So when I did What Works on Wall Street, I did it from the point of view of a practitioner. I was interested in, I wanted the theory to make sense as well, obviously. And I tried to stay as close to the scientific method as I could. In other words, you should be able to replicate my research if you have the same tools and the same data set, and it should have something that makes a little bit of sense. But what do you think about this? Why do we see time and again the persistence of, okay, well, yeah, that's what the data says about private equity and venture capital, but God damn it, that's where I'm going to put my money.
Yeah. Well, I think let's start with the models first. I mean, I think it's about making sense of the world and how we make sense of the world. And I think a lot of people, we want to have a plan and we want to have a prediction of what's going to happen. And often the prediction of what we want to happen is motivated by our desires and biases and goals, right? If I am a Russia hawk, I am convinced that every year Russia is going to do some aggressive foreign policy thing, and the thing that we should do is attack. And so I'm going to put out a string of papers every year about the imminent threat from Russia. And that's just my gig, right? And I think people have those sort of heuristics or biases or attitudes. And as they think about the future, they think that it makes a lot more sense, right? In part because we're sense making about the past, right? We're trying to say, everybody's trying to have a linear story of how they got to where they are, and everything sort of makes sense in retrospect, and there's a cause and effect relationship. And even that, like when you actually start to talk to people and you realize that other people might have totally different cause and effects for the same event that you think happened, obviously for X reason, and someone thinks, whoa, wait, why do you come up with that reason, right? Why reason is the reason it happened. But we're so convinced our explanation of the past is right and that our cause and effect relationships are right, we then extrapolate into the future and think it's a lot more predictable. So if you look at a lot of the problems with these early models, the sort of dividend discount models, sort of the initial problematic one, right? It says forecast all future cash flows and discount based on a discount rate, which is based on the riskiness of the security. And you're like, so if we knew what all the future cash flows were and we knew how risky the company was, we'd perfectly be able to value it. What's the problem? Well, we don't know what the future cash flows are and we don't know how risky it is. So given two imaginary inputs, yes, right? Perfect foresight, yes. And then you move through, and like Markowitz, diversification, it was just like his first step was, I mean, it's almost comical, right? You read the paper and be like, well, if the dividend discount model is right, which it is, wouldn't you just put all of your money in the highest expected return stock? Just put it all in that because that's the highest return. But people don't seem to do that. So why don't they do that? And then he's like, because volatility, right? So like, yes, the high expected return, it's going to reach 50% a year. So you would put all your money in it, except that it goes up and down a lot. So you decide not to. Therefore, we have to introduce beta. And therefore now we want to have a diversified portfolio. So we have an efficient frontier, right? And you just sort of keep playing these things through, and they're all built on this very unrealistic assumption that the future is predictable, either in future cash flows or the discount rate. I think then you sort of say, well, what's the alternative to that? And I'm a big fan, as I think you guys both are, of Phil Tetlock. I mean, you can start with sort of nihilism, right? And sort of say, nothing is predictable. It's all an illusion. We know absolutely nothing. And we're standing behind a veil of ignorance, which, by the way, is a pretty good default assumption. And that leads you to things like buying value stocks, or there's some sort of logical conclusions. If you're behind a veil of ignorance, right? Like, why would I pay for a company to, everybody else in the market thinks it's going to grow 50% a year, and so it trades at 100 times PE. I probably shouldn't buy that because that seems really overconfident. If we know nothing, I should just sort by price because that's going to get me the stuff that people are most pessimistic about, right? So starting with nihilism and saying nothing is predictable is step one. And then step two is sort of saying, what are things are more predictable or less predictable? And that's base rates, right? And that's your book. That's why I love your book, right? What works on Wall Street is like a base rate gospel, right? I've got it right here, right? I look it up every time I think of like, would ROE work in this back test? Oh, let's flip to page this and like, scare down the base rate tables, right? It's so useful because it's telling you, hey, maybe we don't know what's going to happen in the future and we're mostly behind the veil of ignorance, but in similar situations, what have been my probability distributions of outcomes? And I think when you start moving in that direction, right, then you say, well, when do the expected return and the probability is the highest? You're going to quickly get to crises because crises, expected returns are really high and your hit rate probability is really high. So it's like the most predictable thing among a world of unpredictable things is like when your grandmother calls you and says, should I sell all my stock? That's the time to buy, right? Like, there are these simple sort of mental heuristics that actually are pretty predictive and powerful. I think it comes to an alternative way of sense making, right? Which is someone says, gee, I've noticed that my predictions don't come true that often, or like, I'm not that good at predicting the future. And that's sort of like, there's a step of awareness there. And then they say, well, how should I predict the future then? Because I need to predict it, right? I'm not going to say we don't predict it. And they say, I'll find an expert. Let me find an expert who can predict the future. And this creates this huge market for expertise and people that claim expertise. And I think that also drives sort of these behavioral things, herding, people say, well, David Swensen put a huge percentage of his portfolio into private equity, and he thinks it's a superior form of capitalism. And I'm not as smart as David Swensen. He's thought it through. So why don't I just do what he does, right? He's the expert. Let me just copy him. And there's this sort of mimetic behavior that is the result of, I think, the people falsely going from, it's like either A, make your own predictions and just be like a maverick, like I'm going to make my own plans and my own predictions. B, start with extreme nihilism and assume unpredictability and rely on base rates. But those are outliers. Like the vast majority of people in the middle of the bell curve say, I'm not that good. I'm not that smart. Let me find somebody who is and just follow them and copy them. And I think that's what drives a lot of these behaviors. And that's what drives, honestly, I think a lot of the things we see like momentum and trend in markets, right, is just the human mimetic behavior where somebody puts out a forecast and other people start to believe it and then they all start betting on it.
So one of the things that I always struggle with as I'm approaching this, and I think you obviously know the way I look at the market very closely because
you published some things that I've read.
Yeah,
so.
I did a couple of things. So one of the things that I always run into that is embedded, I think, in people's thinking, which I think is incorrect, which is one of the primary, using another Latin phrase here, things that academics especially stick into everything, and that's a ceteris paribus, other things being equal. I have a degree in economics, right? And I remember I was an even more, see, you're so polite. I wasn't nearly as polite. And I was the one always with my hand up. So ceteris paribus, but other things are never unchanged. When action A happens, all sorts of these other actions happen often in response to it. It was actually one of the hallmarks and cornerstones of the economic theory that was dominant as I was in university, which is rational expectations, and kind of really took the wind out of the sails of the Keynesian econometric people, because it was like, wait, so you're saying that if we double tax rates, people's behavior is going to change? And it's funny because I read all the academic papers because I think that there's something going to be there, whether for me to disagree or agree or kind of think about why they're thinking the way they do. The desirability bias is another one. So people find what they're looking for. And so it's very difficult to go into a situation, as you say, as a nihilist. It's easy for me because that's the way I think. I just think, well, I don't know. So I'm just going to see what directionally has worked. And then I think, well, that makes a lot of sense. Like back to momentum, we've tested momentum using the CRISP database, which is from the University of Chicago, Center for Research and Security Pricing. And momentum works in every decade from the 30s on, really reliably with one exception, following a crisis. When a crisis occurs, you would invert and you would buy the worst decile by momentum, not the best. And so I find it's still challenging for people. I think that, like, I study mimetic behavior because I have to, right? Another thing that I think is, for the most part, which is seen as heresy, which is narrative generally follows price. It does not lead price. And so what are your thoughts about, what's going on right now, which I find, by the way, highly entertaining, with the meme stocks and with David Portnoy, who he's a marketing genius, and he uses weapons grade persuasion. He's really good at what he does, but what he does is not in the field of portfolio management, it's in marketing. How does this end? What do you think?
Yeah, it's so interesting. I mean, I coming back to the rational expectations argument, I'm a fan of an alternative theory called rational beliefs, which is a Mordecai Kurtz at Stanford came up with, where he basically said everybody has their own belief system that's rational. And his definition of rational is you can line up all of the available facts about the past to justify that belief system, right? It just turns out that all the facts about the past don't only justify one belief system, which is a big shock to the academics. But it turns out that people that look at the same data often come to different conclusions for very legitimate reasons. And we do not know who is right. Because we can't see the future. So until the future happens, we can't adjudicate who is right and who is wrong. And Mordecai Kurtz's theory is that actually that explains the volatility of markets. It's divergent beliefs among market participants that then have to adapt to a large percentage of those beliefs being wrong when new data comes out, right? And then and that sort of just makes intuitive sense to me, right? How many times have I been wrong? A heck of a lot, right? So probably other people are wrong too. And so a lot of these beliefs must be rational. And that probably does drive volatility because, yeah, if I'm wrong and I see I'm wrong, I do sell something and that does drive the price. So I think that makes total sense. And then I think that you then try to think about how do these beliefs get constructed. And I think one of the things that has happened, if someone says something and then it happens and it comes true, then people believe it. And so, or they're more likely to believe it. And so, and if it happens 2 or 3 years in a row, then they really believe it. And this is, by the way, sort of a funny analog to the fund management world, because I think this is actually how a lot of very smart institutional allocators make their decisions about managers. They bring them in year one and they say, hey, what's your thesis about the next 12 months? And they say, well, here's my thesis. What are you betting on? They bring them in a year later and said, was your thesis right? Did you execute on it? And then what's your thesis for the next year? If they've gotten it right 2 years in a row, great. As a sort of side note, a lot of managers fail the first thing. So our thesis is Russian retail. And then a year later, so it's a funny world. But I think what you've seen in the last decade is a lot of these growth stocks, they did better than expectations. The price went up, more people bought them. It was this big sort of building on itself of story. And I think what's fascinating about Portnoy is he's just manufacturing it at like warp speed. I go out and tell everybody to buy John Deere stock because I saw a deer outside my bedroom this morning. And then Deere stock is up 5%. And I tell them I was right. And then people pile in because they think I'm a genius. And then it goes up another 5%. And it's like very short order. And then I'm going to switch to another meme. And it's like the evolution from newspapers to Twitter. It's like the evolution is from, JPM's market strategist putting out something once a quarter to like Dave Portnoy switching his momentum stock, like based on what animal he sees outside his bedroom, right? And it's fascinating. Now, I think there's sort of some benefits, right? I mean, I think there's sort of two interesting things about what I think is generally a horrible story, which is that there are probably going to be a lot of new micro and small cap stocks as a result of the SPAC craziness, which is great. Now, a lot of them are going to be disasters for the people that invested in them, but give it 2 years and us value investors are going to have a field day and we'll finally be able to, I feel like public equity investors for years have dealt with, I've decided to move my allocation to private equity because the number of listed stocks has gone down since 1998, right? And you're like, well, have you looked at what stocks comprised all the stocks in 1998? Because it was a lot of SPAC-like things. But now we'll finally be able to say, well, now shouldn't you be shifting your money back into public equity since the number of public listings is going up again? So I'm excited about that. And then I think the other thing is that it's interesting to see the cycles of behavior. I mean, you think of how dominant the index funds, buy index funds, only buy index funds. And people stopped owning individual stocks. I mean, they really did, right? It was shifting out of their portfolios. And now maybe there'll be a resurgence in people actually buying individual stocks again, which as a stock picker, I sort of like. Maybe the data for index funds is much better than the results for people buying individual stocks. But I still love the idea of people buying individual stocks. So I think that's a good thing.
Yeah, I agree. I think that sort of nails the thesis that I have about the whole thing, which is the thing that bothers me and I get concerned about is I love younger people, especially, becoming interested in investing. I think that's a good thing. The challenge is that the ratio for everyone who's going to be quasi-rational about it and actually do some study and homework, there is 100 that aren't going to do that. They're going to get burned. And then they're going to kind of swear off stocks and say, that game's rigged. So I agree with you in terms of the creation of new supply in SPACs. I agree with you on the liquidity problem. My worry is that given our base code, I've taken to calling it human operating system, because when you talk about beliefs, people's shields go up really quickly. And I just wonder what will be the reaction. What do you think when the inevitable crash and burn happens? how many people just will walk away from the market forever? That's what I worry about, young people especially.
Right. And especially given what a lot of them are choosing to invest in, which are sort of the worst of the most overvalued. Or look at like what's going on with electric vehicle stocks, right? I mean, I know I said you can really tell when you're in a crisis, it's obvious, and you can never tell when you're in a bubble, but how can you not look at electric vehicle stocks and that sort of stuff and say that's obviously a bubble? And yet that's what most of the investor enthusiasm is driven towards. There are probably two components of it. I think one is sort of coming back to the emerging market. If you have enough individual investors putting money into something, that money actually funds stuff. I mean, the company could actually use it to do something, right? Just like the emerging markets could use it to build bridges or stuff. Now, the investors never made $1 off that stuff, but the people that were running the companies actually might. And another way to think about the EV bubble is to think, well, actually, maybe there's so many people committed to an electric vehicle future that they want to just give these companies money to just go build cool stuff. And they don't really care if they make money or not. I don't know what percent of the people that own EV stocks believe or think that way, but I think it's possible. And it's probably the same thing driving enthusiasm for rockets, right? Well, if Jeff Bezos can dump a few billion of his fortune into building rockets, why can't I take some of my 401k and build rockets too, right? Like, I kind of get that. And maybe something good can come of it. But I think one of my new favorite quotes is from a mentor of mine who says, it's easier to know what will happen than when it will happen. And I think it's obvious that there's going to be a train wreck in these growth shares. And when it'll happen, I don't know. But I agree, the consequences of it for a lot of people are going to be really bad. And I think rather than following Wall Street bets, people should go buy what works on Wall Street and they'd be a lot better off.
The unpaid plug. I'm going to lead with that. So I agree. And I've been thinking about a thesis of bubbles that I heard from several people, which is this idea that you just expressed. In other words, bubbles leave a lot of very cool stuff after they popped. So you think about the dot-com bubble. Well, there was a lot of infrastructure that got built. People lost fortunes on it, but now there's the infrastructure. And in a similar fashion, I like your metaphor for emerging markets. Well, people might lose everything they put in, but that bridge gets built or that road gets paved. I'm a huge traveler, and I think travel is such a fantastic education. But, I was in Bhutan, which is a wonderful place, by the way. But literally, car ride is fear of death.
Yeah.
Because the roads aren't paved and, there's rocks tumbling down. And I think it'd be great if Bhutan got a huge infusion of capital and put that towards infrastructure, because I'm bullish on the prospects of all of these various emerging and or frontier type companies. And I don't mean to sound indifferent to people's losses. I'm certainly not. But my theory has always been, well, as part of our grand experiment here, we're going to have lots of failures. And failures are opportunities to correct errors. And without failures, no progress, basically, because then you're living in stasis and the precautionary principle abides. And if the precautionary principle abides, you're going to try to get everyone to stop doing everything. And I think of like the old forecast from the 70s. Julian Simon has a great book called The Ultimate Resource. And basically, the theme of his book is the ultimate resource is human ingenuity. And there was a guy, Ehrlich, I think he's still around, but he was a superstar in the 70s because he outdid Malthus by like 10 times. Gave lectures about how we're running out of everything. People are going to be starving by the billions in 1980 at the very latest, and it's too late to do anything about it. Well, obviously, and in fact, there's a famous bet between Simon and him in which Simon let him pick what elements were the rarest, and he picked 10. And Simon said, they will all be cheaper 10 years from now, as opposed to gone. And Ehrlich was like, the easiest money I ever made. Well, you know what happened. And Ehrlich sort of, skunked away. But I think that this is something I'm working on right now, because I definitely think it's part of our human source code. This idea of both being pessimistic about the future and the present. And I think that's because of the evolution of our genes didn't keep up with the evolution of our memes. And I mean memes in the memeplex transfer of knowledge. Aggregate cumulative societal evolution has gone parabolic. And we humans, we're still kind of like optimized for the Stone Age in a way. Do you think about those kinds of things, or are you just more of a nuts and bolts kind of like, well, I know nothing, which, by the way, I think is the best place to start from
Yes.
any thought process. I always say that. I know nothing. And
Yeah.
let me learn. Let me learn.
It's funny. I'm a big fan of E.O. Wilson and sociobiology and some of these evolutionary concepts. And E.O. Wilson, I think, said, what are the two most successful species on planet Earth? And the two most successful by body mass, just the aggregate mass of living creatures, are ants and humans. And Wilson says, well, what do ants and humans have in common? And they have in common that they're both extremely social animals. They also have in common that they're the only two species that wage war, which is very interesting, right? There are lots of these sort of fascinating, like ants will wage very sophisticated wars with other ant tribes, just like humans do. It's fascinating, but they're wildly successful as well. And you think about evolution on a broader scope, evolution is a deeply cruel process. I mean, if you think about the actual thesis behind it, it's like, well, 99 of these mutations will result in death, and one of the mutation will result in something good for the species. And you can analogize that in some sense to some of these sort of futurology aspects of the stock market. 99 out of 100 EV companies will fail, but maybe the one that does will produce something cool for people. And that's kind of neat. And so what could be good for society might be bad for investors. And I think a lot about, or I've been trying to think a lot about, not just how do belief structures relate to markets. How can we kind of get a sense of what people's belief structures are? How can we look at them over time? What are they saying in surveys? And how do those surveys result in different behaviors in markets? Which I think is a really interesting question and fun, but also different utilities, right? What do people want out of the market? Do young people want something different out of the stock market than older people, for example? How do people's actual preferences relate to what they own? And I think starting to think about your sort of start with your Spock type perspective, like everybody's goal must be to maximize absolute returns. And then you just sort of walk that back and you say, well, how many people have I met that actually very coldly calculate expected returns and hold the highest expected return thing? Like none. So there must be something else at work. So what do people want, right? What is the purpose of their investments and how does that overlap with beliefs? Which I think is so important now, right? With the development of meme stocks and the power of these growth stocks to drive really huge market moves and the desire of people to invest in innovation ETFs. You just can't separate what's going on in markets from the reality that markets are made up of people. And I think people do have some behavioral attributes. And that's one of the things I love about crises and crisis investing. It's obviously sort of hardwired what people do in a crisis. They're scared. They listen to experts. They extrapolate from the recent past. So-and-so who predicted the crisis and shorted stocks 3 months ago thinks it's going to get even worse. And so you should probably listen to their advice because they were right. Versus, I think, this alternative approach, which is, to be driven by base rates and to say, rather than thinking what worked over the last decade in the market, why don't I think right now, given where valuations are and where the yield curve is and where the high yield spread is, and what would similar situations have looked like in the past in terms of expected return across different assets. And therefore, maybe my behavior should be dramatically different because the stuff that worked best last decade might be the most overvalued this decade. And conversely, the stuff that's most out of favor might actually work. But unless you start from a base rate driven approach, you're going to be so driven by narrative and trend extrapolation and confirmation bias and sort of the herding that everybody else is doing it. So you should probably do it too, that I think it can lead to a lot of bad decisions.
Yeah. And I've been a quant. It's so long that it's in my DNA, and I will get physically uncomfortable if I'm in a crowded trade. Because I just have this intuition. If I'm in a crowded trade, I'm wrong. Even though I'm following the base rates, even though I'm doing all of that and I'm following the results of the model, I do not like seeing company. I like people telling me that you're insane. Yes. Why are you doing that?
Yes.
Because that gives me a much higher degree of confidence. One of the last things that I want to ask you about is something that has kind of been a pet project of mine, which we haven't been able to put all the brainiacs over at OSAM Research on because we're spending all our time with Canvas. I'm sure you pretty much know about that.
Congratulations.
Oh, thank you. Thank you. Entirely team and Patrick, fantastic. I love it. So I have a thesis that basically is The stock market is a complex adaptive system with feedback. The reason it clears most of the time is because, as you noted a moment ago, people have very different expectations and desires from participating in the stock market. So we could say that their viewpoints are heterogeneous. They're very different. So I could sell Apple to you, and we could both be right by our own thinking. You're buying it for a child's future education. I'm selling it because I want to give the money to my grandson. Something very simple. And this is why markets are generally efficient. And I don't mean that in terms of reflecting all, I mean, they clear.
Yeah.
And in crises, we know they don't clear. So that changes when feedback turns into what I call an information cascade. And that information cascade is mimetically so powerful that people's opinions become homogeneous. In other words, they're all thinking the same thing, right? I think that when that happens, you're talking about the end of a bubble or the beginning of bad things, talking about a black swan, which by definition can't be predicted. But my theory is you might be able to confirm that a black swan has occurred. And the reason I'm going into this is because your thesis on emerging markets and crisis is a similar, with a different narrative, but it's a similar point of view as this idea of mine. I think that the ability to confirm a black swan, because by definition, you can't forecast a black swan, but the ability to confirm that one has actually occurred would give one an enormous advantage in markets if one had the flexibility of mind to say, okay, the data is now confirming this for me. The black swan did in fact happen. I think though that, again, my hypothesis is this is going to need machine learning. This is going to need a huge data set, which by the way, my entire Twitter feed is designed to
it's all one big experiment. Thanks for playing.
But what do you think about that? Do you think that it's possible? Because going into this, and it's been my hypothesis for 20 years, really, and machine learning came along and I'm like, ooh, I might be able to actually run some real tests on this. Do you think it's possible to confirm, not forecast, but to confirm a black swan has occurred and therefore I might want to be doing the opposite?
What's like a tangible example, Jim? Can you make it less abstract?
Of course, the last great financial crisis, the collapse of real estate, the collapse of CDOs, all of that. And this is what got me really wanting to test it, honestly, because for the year prior to that, I was still at Bear Stearns at the time, but I had been walking around telling any other senior managing director, if you can short your house,
Yeah.
because this is insane.
Yeah.
This will not last. But I'm such a quant, I didn't act on it because I didn't have any quantitative information or base rates or all of the things that I've relied on for my entire investment career saying, yes, Jim, you're right. That's kind of why I got it. And we think now, by the way, that everyone knew that it was a black swan. No, they did not. Go back to the source material. And if you go back to the source material, there were months and months and months after the decline had begun where everyone was saying, oh, no, this is fine. This is fine. This is fine. Wasn't fine.
Yeah, it brings to mind, I mean, I think when you start to think about belief structures, there's two related concepts come to mind, which are consensus and salience. Well, consensus is, how much does everybody agree on it? And then salience is how sort of impactful on a mimetic level is the event that changes the narrative, or what are the events upon which that consensus is built? What are the fact patterns in which that consensus is built? And when the black swan comes, how disconfirmatory is it? And how quickly are people to adapt and change their beliefs? And that is a fascinating question. I don't know how you'd test it or prove it out, but I think the idea that the only way to break a consensus bubble like that is with a salient event that changes the underlying fact pattern has sort of got to be right? There's got to be something that destroys the narrative. By the way, this is purely speculative.
Yeah, we should make that clear. This is purely speculative on my part as well. you're a very smart guy, and that's why I'm seeking your thoughts on this, because like usual, I'm going into testing this hypothesis with the null set being expected, right?
Yes.
So I'm expecting I'm going to find nothing. I'm still going to look.
So one random one about sort of current market events, and I've got a few different ones, but I sort of think what's a salient event that destroys a narrative. And I think one really popular narrative right now, and there are a number, but is we're not in a bubble like 1999 because the fan mag stocks are actually good businesses with high margins and very high growth. And if you look at their contribution to the stock market's earnings growth, it's been massive. Therefore, their valuations are worth a very big premium and it's not a bubble. Other things other than the fan mag stocks might be a bubble, but not the fan mags. They're just great companies at the right price. That species of narrative, I think you could talk to like everybody from great value investors to great growth investors, and they'd be like, yeah, I agree, of course. What could possibly be wrong? And one of my sort of very speculative theses, I'm almost certain to be wrong on this, but if you just have one of these big ones have a negative revenue growth year, or even what happens? Take Amazon, right? Like, let me play out a narrative where COVID turned out to be the best year ever for Amazon's retail operation. Why? Because people were sitting at home, they had nothing to do, and they were terrified to go to the store. So they just bought stuff online and had it shipped to them and shifted all of their purchasing online. And then the minute the pandemic ended, people thought, wouldn't it be fun to go shopping again? Instead of sitting on my computer buying stuff online, I should go out and play soccer with my friends. And then what if Amazon's retail sales didn't just grow less than expected, but went down? Yeah. What would happen to this entire narrative? That salient event would say, oh my God, maybe they're not growing into perpetuity, right? Maybe they're not just great business. Maybe they're cyclical too. And I sort of start to think like, who knows how low a probability case that story is, but certainly a very low probability one. But you start to think about other potential salient events that could puncture a very consensus narrative. The other one, I think, on the private equity side is a top tier private equity firm doing what Greensill just did, where all of a sudden, holy smokes, it just blows up. And people say, oh, I get it. Like an illiquid 10-year lockup can lead to this type of behavior when I trust them to give me the marks. And I think you just need a few of these really salient events to have such a dramatic shift. There's a great study that looks at value and growth stocks and how they react to news. What they found is that value stocks tend to have a positive reaction to news and growth stocks have a negative reaction to news, because what's sustaining the growth stock valuation is a narrative about really great past data. And the future just unfolds relatively unpredictable and is sort of inevitably going to puncture it for whatever reason. Whereas value stocks, it's built on a very negative narrative that strings together the past facts, and then a new fact occurs, and it's rarely ever just on a straight line linearly down like all the past facts. And so I think that there's got to be some way to test that or run machine learning or broaden that thesis out. But I would be fascinated to see it, Jim.
You've actually just described some of the format of some of the questions we're going to be asking through machine learning. So we have this thing called OSAM Research Partners. Jesse Livermore, one of the most brilliant guys I've ever met in my life. He doesn't have anything to do with the stock market, but when you give him the database, oh my God. And we have a fellow who's also an expert at machine learning. And he came up a couple of years ago and gave the firm basically a day on machine learning. And it was great because it took away all of the magic that people infer or imply is present in AI. And Kevin just was like, no. Don't believe any of that. That is what marketers are telling you. But I'm going to tell you why this is still very powerful. And really, it's kind of like, just think of the old decision tree, but think of it at hyperspeed. So it becomes much clearer why it works, because it does in a fraction of the time what we as human beings literally either couldn't do, or if we tried to do it. I often think about NASA with their human calculators. Back then, they didn't have computers and they called their staff calculators because that's what they would do. And so this is a very temporal phenomenon, I think, because what machine learning does is it compresses what would take humans, if they even deigned to try it, decades, like the vaccine. How long did humans try to fold protein? How long did it take AI? So that part makes a lot of sense to me. because it demystifies it. It's not like some magic. It's a very profoundly pretty simple at its core. What it does, however, is it gives you the ability to compress into a day what would have taken a decade for we humans to do. So there is this theory. For whatever reason, I'm very popular with young people, Zoomers and millennials. And I think one of the reasons for it is the gifts, honestly. But one of the things that I love is there's like these three schools of thought. The one, I'm not going to tell you about the other two. I'm going to tell you about the one that amuses me the most. And it inevitably, when I dig into it, I find that the holders of this view are almost universally techies.
Yeah.
Okay. And this view is a 60-year-old white male. It is inconceivable that he could come up with these gifts that match perfectly as a response. Therefore, it is AI that they're testing surreptitiously and not telling us about.
That's amazing. I love it.
Well, of course, you know what I do. I feed it.
Yeah. Yeah. And Jim, I won't tell anyone the truth. I promise.
I really appreciate that, because before we started recording, I admitted to you that anyway.
Or the hologram that I'm talking to admitted.
Exactly. The virtual Jim is, I keep saying in beta. Yeah, he's not in beta. This has been great, Dan. So one of the things we always ask at the end is, it's kind of fun because it really allows us to kind of see where your head is at in terms of if you could do something and actually people would do what you said. So our question that we're going to pose to you is this. We're going to wave a wand and you become emperor of the world for a day. You can't kill anybody. You can't send anyone to a camp for re-education, but you can kind of be like, you get to hack human OS and you get to implant two ideas or types of behaviors that humans would engage in after your day as the impresario manifester of the empire. What two things are you going to put in people's minds and change their behavior about?
Well, it's such a terrifying question, to be honest, Jim. I mean, I am a believer in the idea of subsidiarity, right? That the decision should be made at the level closest to which they're made, right? Or even Hayek, right? Or someone saying the price mechanism is the best mechanism. I can see no circumstance in which implanting pretty much any idea in anybody would result in anything good. I'm so opposed to consensus, Jim. I just feel like maybe the one would be just, then you think if we tell them don't trust authorities, so where does that lead, right? Like, so I just don't think it's good, right? Like we need human cognitive and intellectual diversity, right? And diversity of opinion. I honestly think that one of the sort of sad things that I worry about, I don't like consensus. I really don't. And I hate it when it's forced consensus or when everybody forces you to think some way. Actually, my wife and I, we came up with a phrase which we like to use sometimes as a tool where we say, well, is it possible that a smart and well-intentioned person could disagree with you on that? And you'd be shocked how often the answer these days is no. It's not possible. And you just say, well, I guess I'm just going to stay really quiet because if I say what I think, you're either going to think I'm evil or stupid. And I don't want you to think either of those things. So you're just going to think I'm quiet.
Well, I love that response because, and that's why I came up with the question, by the way, because I think just like you do, I don't like consensus. I don't like being told what to thought, but it's part of the scientific method. The ethos that the Enlightenment gave us is that we have to allow criticism. We have to allow, in fact, not allow, we have to seek out people disagreeing with us, because if they don't, our theory will die in the water because it hasn't been questioned. And so one of the things that I was expecting you to say was that you would make people more open to discussion and less fearful about stating their actual preferences, right? Because another thing that we could do an entire hour on is stated preferences and revealed preferences. I don't think the gap has ever been wider. And I've been around for a while and I pay attention to these things. And it's an epidemic among young people. I talk to a lot of young people and like, that's the first thing out of their mouth is, I'm afraid to say what I think. And that is not an environment that leads to progress, innovation, change. that is an environment that leads to witch trials. And I have a list like Senator McCarthy. I don't have a political party because none of them reflect the way I think about things. I guess I'm anti-authoritarian. Okay. So of any kind, of the left or the right. And so if I were doing it, it wouldn't be anti-authoritarian. It would be think for yourself, I guess, would be one of the ones that.
Maybe I'll give one, which is
I knew you were going to do
right,
it.
the Solzhenitsyn quote where he says, "Live not by lies."
Oh, I love it. See, that's so great.
But that's what you see a lot of people live by lies. It's very sad. Why are you doing this? Because I just want people to think X, Y, or Z about me. And so I'm not going to reveal the truth of what I think. I mean, it is horrible, right? But we live in a wonderful free country. Why should we be afraid to express our views, or in many cases, afraid to listen to somebody express views we disagree with or get so angry about it? It really is sad. And I think part of it is a failure. This sort of rational expectations versus rational beliefs debate that happens in markets. People need to read their Isaiah Berlin or whatever and realize, gee, it's not that this person is stupid or evil. They just see the world differently. They interpret the world differently. They see the same facts and come to different conclusions because they have different values or different hopes or different expectations that are reasonable. And if I can just ask them more about it, I can figure out what their reasons are. And it's probably going to be kind of interesting. But people just assume like, wow, well, if you disagree, you must be evil or stupid, right? It's just, and that's why people don't want to express their views, right?
I love it. And live not by lies. What a great one. I'm stealing that from you immediately.
Well, I stole it from Solzhenitsyn, so
that's great. That's great. That's wonderful. Because that's a sub part of my other theory that we were discussing, that if you have a mechanism that you have greater insight into revealed preferences versus stated preferences, well, that's some interesting data.
Right.
So Dan, this has been as fun as I thought it was going to be. You are a wonderful guy. I wish you all of the greatest success. And what's next for the company? Are you adding people, subtracting people?
We hope not to subtract anybody. But no, we're doing a lot.
Yeah, I slipped that in there.
Yeah, exactly. Yeah. We're deleting 4 people tomorrow. We hope it's not you, but we're going to pull the names out of a hat. No, we're ideally not. We're doing a ton of research. I think that what I've gotten really interested in, stemming from this crisis work, and we've been doing a ton of work on crises, is saying, okay, well, what to do when you're not in a crisis, right? And I think we've been trying to look at a lot of the research into macro variables and how those predict how different asset classes do. And can you structure an approach to asset allocation that's counter-cyclical, that takes into account expected returns, that takes into account where the macro is. I'll give you just like sort of one of the random case studies of something that we've been looking into, which is totally random and anecdotal, but fun, is oil futures. Okay. So if you look at like the long term of oil futures, it's got like pretty much on a real basis, a 0% return, a max drawdown of 90%, and like a crazy.
What's not to like?
So you look at oil futures and you're like, holy shit, this is just the most, why would anyone, certainly you don't want to have a permanent allocation to something that looks like that, but it just terrifies me. It's just seeing those max drawdown stats. So then what I tried to piece together was to say, okay, well, certainly sometimes oil futures have to work. Otherwise, people wouldn't be so drawn to them. Like, what are the conditions under which they work? And ran a huge ton of different tests and tested all different variables and read the whole literature on it and came up with 2 that are really interesting. One is that when the real price of oil is below its long-term average, that's a positive signal. So, okay, right, that makes sense, right? When oil prices drop, they stop drilling, the price rebound, mean reverts, and when prices get really expensive, people drill and the price goes down. So you're like, okay, got it. Like oil should be mean reverting, and it turns out oil prices are mean reverting. So buying oil futures when oil prices are below the long-term mean. Okay, good. That only gets you part of the way, though. The other interesting one is my favorite macro variable is the high yield spread, which is a great sort of contemporaneous measure of economic conditions. You know, when the high yield spread is really wide, borrowing is shut down, you're in the middle of a recession. And then when the spreads are really tight, it tends to be sort of late cycle inflation, excessive credit creation, et cetera. And actually, it turns out that if you look at oil futures and you segment it out by quartile, oil futures do really well when high yield spreads are really wide, right? So think of like March of 2020. If you then bought oil futures, you did well because the economy then recovered. And then they also work really well when high yield spreads are really, really tight, which is because there's inflation. And if you pair those 2 things instead in the, call it 25% of market environments where those two conditions are met, where prices are below average and the high yield spread is extreme, that's basically like 100% of the returns in oil over the entire history have come in periods that met those two preconditions. And you've been better off not even touching oil futures the other 75 or 80% of the time because you were owning an asset with 0% return and 90% max drawdown. Right. So we've been trying to think other sort of conditions where are there other asset classes or places like not just emerging markets or small value stocks where you actually only want to be in them on occasion because the conviction level is just so much higher under certain conditions than it is under others that there's these conditional probabilities or base rates. And I know this is pushing far out into the heretical because I think a lot of people are so averse to any sort of market timing. And of course, there's a lot of data mining risk to any sort of type of investigation along these lines, I think is worth pursuing. So that's where a lot of our sort of research efforts are focused.
Fantastic. And for everyone listening, I always think that Dan and team's research is first rate. I always read it. I think you should too. Dan, thank you so much. How do we find you on Twitter and how do we find your website?
My Twitter is @ForDadCap and my website is fordadcap.com. And we write a weekly email. It comes out at Monday mornings at 9 a.m. I've been doing it for a few years now. And if you like this podcast and would like to read more of our research, I encourage you to sign up for it.
Terrific. This has been great. Thanks a lot.
Thank you, Jim.
Cheers.